This is the Friday, October 12th, 2018 version of the Market Plus segment. Joining us now is Tomm Pfitzenmaier. Tom, welcome back.
Thanks, Delaney.
Tom, we didn't get to talk about feeder cattle during the main portion of the show, so I wanted to ask, we saw a $3.60 drop from last week when we talked about it on the show. What's going on in the feeder cattle market?
I think there are two markets. I mean, there's two things that kind of drive that market. One is the fat price and one's corn. Well, you've had corn creeping up here for the last 3 weeks, and at the same time you had this break in the fat market. So I guess it's not a huge surprise. Actually, it's maybe it's a little supportive that it didn't drop more than $3. So I think that's what that was all about in that market.
If corn continues to show some strength here, do we expect to see feeder cattle continue to drop?
Yeah, there might be a third issue, actually. These rising interest rates makes make the cost of carrying cattle and all that stuff a little more expensive. And I guess I wouldn't be surprised to see if that wasn't in the mix of a little lighter prices on feeder cattle too.
Okay, those three factors. What about when we look at the cotton market? Because I know we didn't get to talk about that either, and they've got a lot of news going on with the hurricanes going on. How much is that impacting the cotton market right now?
Well, you said at the beginning, when you were doing your lead-in to the show, that cotton prices had jumped pretty good the last week, and then I think that was all driven by was all hurricane driven. The question in my mind is, can you sustain that?
Right.
Can it go any farther? How much damage was really done? And then we bang right up against this Chinese demand situation. A bunch of our cotton goes to China, and that obviously our trade relations aren't that great there. I think people are trying to be optimistic because the Chinese president and U.S. president are going to meet at the G20 meeting in November in Argentina, and that maybe hopefully something will get done, and that's bringing some buoyancy to the beans and to the cotton, but I'm not sure that's stuff that's all that sustainable. So certainly if you get December cotton up in that 80-50 range, I guess I'd pretty quickly turn into a seller.
Okay, 80-50.
Right.
Okay. What about when you look at hurricane impacts in the hog market? North Carolina is a big hog producing state. What impacts are you seeing there? Yeah,
see, that's something we didn't talk about on the show that we probably should have too, and that's been a real disruption. I mean, they're one of the biggest producers of hogs in the country, and you've had some plants that have shut down, which backs hogs up, puts weight on hogs, keeps consumers from eating pork. So I think we just kind of recovered from Florence, and then Michael hits, and I think there's a lot of disruption in the hog industry, and we're still not sure what the total impact that's going to be. But I can't think that it's bullish.
I can't imagine
as you bottom it, the bottom line on it.
The other thing we talked about quite a bit in the show, and a lot of producers sent in questions about, is weather. Tom, we've got to break it down for people. Starting off here with Mitch in Colby, Wisconsin. He wants to know how much of the recent weather abnormalities have been factored into the USDA report this week.
Well, I don't think much. Like we talked on the show, a lot of that data was taken before all this. I mean, it was a little rainy and a little wet, but it hadn't really impacted on a longer term basis. But when that data was taken, so that's why I said on the show we may see a little scale back in yields or in harvested acres because of that. So I think maybe we have yet to determine that.
The other good question, I think kind of follows up with this really well, is from Michael in Minnesota, and that is, does the market care at all that this crop is stuck in the field because of weather and whatnot?
Not really. Again, I'll go back to what I said in the show. When you got an 885 million bushel carryout, who cares if you don't harvest 50 million of the beans? I mean, it's a problem if it's your field and you can't get your beans out, and your bean quality, like Brock said in the first segment, is a problem. But in the big picture, there's still going to be a lot of beans. Most of them are going to get harvested sometime or another. So what if we lose a few?
How many acres would we have to lose for the market to care?
Millions.
Okay. And we're at 600,000 approximately right now.
Yeah.
In the soybean market in particular.
Right. Yeah, and what effect did it have? I mean, barely any. So yeah, when you've got that big a carryout, you got a lot of slop.
So I guess we kind of answered this question. Bill in North Dakota, how much snow and rain damage will it take to move the soybean markets?
Quite a bit, I think. I mean, to be honest with you, I don't think anybody's all that concerned about it. It might give us a little rally. I'm not saying you aren't get 25, 30 cents out of it, but it's going to be tough to get much beyond that. Plus, we don't know. There's better weather in the forecast. We could see that snow in North Dakota melt, and they're right back out in the field in a week or two. So, you know, there's a lot of that's unknown here.
Why did we see some strength here at the end of the week in the soybean markets in particular then? Well,
I think there is some perception that this meeting between the president and the Chinese in November is going to yield some sort of a resolution that somehow, some way, we're going to make everything's going to be wonderful again. That's part of it. I think there's the whole market was freaked out about inflation last week. And I think there's some thought that there's going to be rotation by some of these fund managers out of equities for one thing and into commodities as an inflation hedge. So he's had some of that going, which prompted some fund short covering. And then there are some that believe we're going to see some damage to the crop because of this rainfall. Now, I would submit that some of that may be offset next week if the weather turns around.
Right.
So that's what we're going to have to watch for early next week. If the weather turns around, that's what I'm saying. You better use this rally to at least make a few sales.
Okay. And Tom, that sets us up well for the last question when we're talking about the equities market. Joseph in Wisconsin would like to know, with the 1,500-point downward slide on the Dow Jones Industrial Average, how will this affect the grain markets short-term and long-term?
Well, I guess we touched on it. Potentially, it could seem some, if they get really freaked out about the equity markets, you might start to see some rotation out of equities and into commodities. I guess it's yet to be seen whether that is going to translate, whether people are really going to want to buy some of these commodities, especially ones that don't have that great of fundamentals as an inflation hedge. I mean, I just don't see selling my Amazon stock and buying a bean contract.
Is there any commodities that stick out to you as one that the equities might like to trickle into?
I guess I wouldn't be surprised to see them move into the energy markets. You know, maybe gold and silver. Those are traditional safe haven inflation hedge type things.
It doesn't sound like you're saying ag commodities, though, specifically like corn, soybeans, livestock.
I think that's a bit of a stretch.
Okay.
I mean, you know, some of these people are going to buy a bundle, and if you buy a bundle of commodities, corn, beans, catalogs are going to be part of the bundle and could benefit. But I don't. Other than that, that may be a stretch to think that that's going to happen to them. I mean, one of the things we didn't talk about, you probably need to if you're going to talk about inflation, is what's the Fed going to do? You know, and their big data point is that PCE deflator as a measure of inflation, and that hasn't gotten really out of control. It hasn't gotten above the levels that they get concerned about. So we may be getting a horse a little bit cart ahead of the horse here a little bit on our inflation fears.
Explain that to me a little bit more. Why are we getting ahead?
I just think they're anticipating inflation that, I mean, if you just look at oil prices, for example, well, you say, holy smokes, we got big inflation because of oil prices. Well, there's more to the economy than that. I mean, and then maybe look at wages. Wages are going up, but they're not skyrocketing going up. It just means to me that the economy is pretty strong and they're pushing wages a little bit. So I don't know any of the major measures of inflation have gotten away from us. I just think the market's gotten a little anticipatory and maybe has a worst case scenario in for what we know today.
All right. Tomm Pfitzenmaier, thank you so much. Always a pleasure.
All right. Thanks.
Join us again next week when we'll explore how high school students manage the local grocery store, and Ted Seifert will join me at the Market to Market table. Until then, thanks for watching, listening, or reading. I'm Delaney Howell. Have a great week.